Welcome to the VMA school. As announced and as promised to you guys, so we are coming up with a financial modeling series that is free for all of you on our YouTube channel. So basically, guys, how we will plan this out is that we will be uploading the parts by parts video for this financial model, and we will start it from very scratch, which means that we will pick up a blank Excel and then we will build out the financial model from scratch, right? So whatever assumptions we are supposed to take and whatever calculations we are supposed to make, that all we will cover under these videos, right? First of all, the model that we are going to build, so that model are well formatted, and also it is one of the best model that we use in our corporate worlds also, right? So basically, guys, in order to teach you these financial modeling lessons, we will be covering through a case study that you can see on my screen. Now, I will request you all to please subscribe to our YouTube channel and to please pass on this video to your friends, to your WhatsApp groups, to LinkedIn, or wherever you can, so that it reaches out to the maximum students and maximum students can get benefits out of it, right? So guys, let's our first series, that is learning financial model for free, and the model that we are going to build is related to a project finance model, right? So guys, let's start. So basically, if you go through this case study, then you can see that there is a company A which wants to set up a business, right? So guys, first of all, before starting, I would again like to reiterate here something. I would like to say you that the numbers which are used over here are most of the dummy numbers, right? So don't worry about numbers, guys. Just focus on learning financial model, how it is built, right? What are the key components out of it, how to build a professional financial model and all, right? It is necessary to learn financial modeling because whenever you are appearing for interviews in big companies like Big Fours, or there are other companies also like Equity Knowledge Partners is there, or SG Analytics is there, most of the companies will give you a case study and they will ask you to make a financial model out of it, right? So guys, this is very important, and also you can't say that your financial model was not well formatted because you don't have time, so on and so on. So these all excuses don't work, guys. Please build a well formatted financial model that in the same way you can build it as we are doing in this particular video. We will show you the formatting also step by step, how we are doing it and how we are coming up with a good financial model, right? So guys, so basically in this particular case study, there is a company A which wants to set up a business, right? As told to you guys, this is a project finance model, right? So in project finance model, what generally happens is that basically you are supposed to make a financial model where there is currently no business, right? So the investor wants to start a business, right? And they want to understand the feasibility of the project if they invest in this particular business, right? So basically, generally in project finance models, you will have two phases. One is your construction phase, and the another one is your operations phase, right? And then in some models, you have post operations phase also, right? So basically, guys, see, actually, whenever you are dealing with financial model, there are two type of models which I understand, right? One is the project finance models. If I talk in broader category, guys, but if I divide it into subcategories, then there will be lots of financial models or lots of types of financial models, right? But in broader categories, if I divide it, then number one is the project finance model, where I just explained to you guys that the business is not currently set up. You are supposed to phase out the construction phase in the model, then operations phase, and then calculate the returns and all, right? Then the next set of models are valuation models, right? So you guys must have seen lot of posts on LinkedIn, on Instagram, right? Or on your WhatsApp groups where people say that they have built out a financial model for Airtel, for an example. They have built out a financial model for, you can say, SDFC Bank, for an example, right? So basically, guys, what is the difference here? So basically, in valuation model, generally the company is already running its business, right? And they want to get a value of their business, right? So historically you will have past 3 years 5 years data, and then you are supposed to forecast for 5 years 10 years depending on the tenure of the business, right? So for example, if it is a small startup, then you may forecast it for 10 years, right? If it is a well established company like HDFC Bank, then you may forecast it for only 5 years, right? So in this way, depending on the situation, you guys forecast it on the basis of your past historicals, right? And then there are some steps involved in it, and then you arrive at a valuation of a company, right? So basically guys, this is all regarding a valuation model. Now valuation models are easier to learn. A pretty set of standard is there, that pretty set of formulas is there, right? So valuation models are relatively easier to understand, but project finance models are little bit challenging as compared to valuation models, right? But guys, if you know project finance models also, then believe me, like you always have an edge among others, because there are lots of things that are involved over here. So we will try to let you guys know whatever the steps are there, right? And we will try to teach you guys through our YouTube channels and through our courses as well, right? So basically guys, if you go to our YouTube channel, then you might have seen that before posting this video, we have posted the videos about flags, right? Now flags are an important part of a financial model, right? So in valuation model, you will generally not see any flags, right? But I'm not saying that it can't be built in a financial model. It can in a valuation model. It can be built in a valuation model as well, but in project finance models, it is definitely to have flags, right? So I'm just telling you an example, guys. It's not something that any model is superior or any model is inferior to other model, right? It's just a thing that what is the requirement, right? And as a student or as a fresher, you always want to have an edge among others. So I will let you guys know about the advanced part of the modeling, that is project finance modeling, right? Now guys, if you look at the job descriptions also carefully, very carefully, right, then you will see that most of the companies ask for that that the candidate should have knowledge of renewable modeling, should have knowledge of real estate modeling, should have knowledge of project finance, should have knowledge of debt sizing and all, right? So guys, these all things we will try to cover as we progresses on, not through this case study, but we cover this in our course that we teach to our students. And also we will try to populate some videos on this on our YouTube channel. So guys, let's get back to our case study. So here there is a company named as A, which wants to set up a business, right? Now the company will deal in manufacturing products related to the laboratory, right? So basically company is setting up a business where they will uh, like manufacture the products related to a lab, right? Now they are planning to launch two products. So basically the company says that okay, I will only sell two products. So one product is sterilizers and the second product is incubators, right? So basically it's kind of a company who supplies the materials to the labs, and the materials which they think of that they can supply to the labs are sterilizers and incubators, right? Now the company is going to start its business on 1st January 2025, right? So basically guys, the commencement of business is going to start from 1st January 2025. Then the company has hired you as a financial advisor and wants you to build a financial model for 10 years, right? So basically here the company wants that okay, please build a financial model for 10 years for me. Then what is the requirement of the company, right? What company wants you to calculate out of this project, right? So basically company here wants you to calculate equity IRR from this project, and you can say project IRR also we will calculate from this project IRR, equity IRR, and also they want to have a cash waterfall calculated in this particular financial model, right? So guys, what is a cash waterfall? Don't worry about it, we will teach you in this particular course. So at present you can think of like you are supposed to calculate equity IRR, project IRR, and the cash waterfall. Then there are some key assumptions of this project, right? So guys, first of all, in real world, like you can see, I have listed out the key assumptions in a well established manner, right? But in real world, this is not the scenario, right? You will not have assumptions in such a beautiful manner written down on a paper, right? So you are supposed to calculate, you are supposed to gather the information from your clients, or you are supposed to gather the information on the basis of market study and all, right? And then you can have your assumptions built out in the model, and then you can start building in the model, right? Now, one thing that is very important to note here is that your financial model should be dynamic enough that it can handle all situations. Right? By this, I mean that your formula should be well dynamic enough so that if any user of the model changes any inputs, then he or she can get the desired results. Right? So, guys, first of all, let's try to look at what are the timelines and all. So, guys, let me tell you one thing. So, this is the question that I generally gets from my lots of students. You can say, right? So, first question that is then in their mind is that, sir, let's suppose I'm on a project, right? I have a blank Excel. I have some set of assumptions. Then how can I start building out the model? Right? From where should I start? Right? So starting problem is generally the concern for the students, right? So I always say, and I always tell to my students that please always start from gathering the information about timelines, right? So the first piece of information or the first piece of inputs in your financial model should be related to timelines, right? And guys, in the case study, whatever are the important information, you should highlight it out so that you don't forget to put in any assumptions in your financial model, right? So, guys, first of all, we will try to look at what are the timelines. By timelines, I mean when the project is getting kicked off. Right, when the construction is phase getting started, when the operations phase is getting started, right, when the debt repayment will start, when the payment will come to my business, right, when I am supposed to pay the dividends, right, when I am supposed to close out the loan, right? So these kind of information you need to have at a starting point, as a starting point, you can say, right? So guys, in this particular thing, you can see that we have a capex timeline. So capex I have divided into six categories. So number one is land development cost, storage area, production area, furnitures, utility, and other capex costs. So there are total of six capex categories that we will build under this particular financial model, and each capex has an estimated deadline, right, or estimated time. So basically, first of all, see, actually, you can imagine, right? You want to start a factory, right? You have a barren piece of land, right? Now, what will the first expense that you will occur? Right, so first expense will be related to land development, right? First, you are going to develop that land so that you can construct building on it, right? So, guys, here it is said that land development cost will take 26 months, then storage area will take 2 months, then production area, furnitures, utility, and other capex cost. So in this way, you can see every capex is divided into a certain number of months. Now, total number of months, if I can think of that, till how many months my capex is going to like be my like till how many months I am going to incur capex, right? So it is currently 36 months that we have assumed in this particular case study. By 36 months, I mean that 3 years will be for your capex. So for an example, if you are starting from 1st January 2025, then your operations will only start after, right? Because your capex will end on 31st December 2027, right? And your operations will start from 1st January 2028, right? So this is the basic information that you have right now, which was very important to set up your model, right? And also, guys, when I will start plotting out it in Excel, I will show you how I am going to utilize this information, and with these informations, how I am going to build my model and move forward in my model. Then, guys, next thing. So I have my timelines, I have my capex requirements, right? Now, the main thing that a business or you can say setup is concerned about money, right? Or capital, from where the money will come. So, guys, in this particular case study, we have assumed that the money will come from a debt, which is basically your loan. 70% of your requirements will be financed through loan, and 30% of the requirements will be financed through equity, right? So, guys, here we are not assuming any debt sizing, sculpted debt repayments, anything, right? We are just keeping it simple for the moment. But yeah, debt sizing is a very important factor when you are supposed to calculate the loan amounts. How much loan amounts can a project can survive, right? But here we are not considering those difficult situations. Here we have kept it simple, that my debt holders will, sorry, I will get the loan as 70% of my total project cost, and 30% will be financed through equity. Then we have guys product assumption. So basically, I have two kind of products which the company wants to manufacture. Number one is your sterilizers, and number second is your incubators, right? Now it says that at the first year of my operations, it is expected that if I am at full 1 year of operations, then I will sell 117 products, right? Or 117 units. Now, let's suppose, guys, if I am not at full 1 year of operation. So, for an example, guys, what do I mean here? Let's suppose in this particular case study, I am saying that my operations will start from 1st January 2028. Right now, what does this mean, guys? This means that if I close out my income statement, let's assume I'm building an annual financial model, right? So my financial model timeline starts from 1st January to 31st December. So this is a full year, guys, right? Now, since I'm starting on the very first day of the year, then I can say that, okay, for this whole full year, I am operational. Now, let's suppose there is another instance where I am starting my business from mid of the year. Let's suppose my construction get ended on 31st of July 2028, and then I can only start my business from 1st August 2028. So in that particular financial year, assuming it to be from Jan to December, so in that particular financial year, you can see I am only operational for 4 months of the year, right? So if I have assumed that if in a whole year, at my first year of operations, I can sell 117 units of products. So this is basically assumption that if you are at 12 months of operations. Now, if you are not at 12 months of operations, then you will not be able to sell 117 units of sterilizers, right? So in that case, guys, you need to factor it out, or you need to prorate it out on the basis of number of months that you are operational, right? So, guys, just it's a pure, you can say, um, a unitary method kind of match, where you take an example. Let's suppose 100 oranges cost 500 rupees, then what are the costs for my 10 oranges? So here it's the same thing. If I have been operational for 365 days in a year, then I would had sold 117 units. But what if I'm not operational for 365 days in a year? Then you need to prorate it out using unitary method, right? So, guys, this is all the assumptions. Then we assume that every year your unit sold growth rate will be 4.5%. Then price per unit is 25 INR thousands per unit. Then price premium is 0%. Guys, one thing is very important. You need to focus on the units that is getting used, right? Be very careful, guys. Be very careful, right? You can think that you have built the model very correctly, right? You appeared for an interview, you are confident enough, अरे यार मेरा तो हो ही जाएगा इसमें, right? I have built the financial model, अरे यार बहुत बढ़िया बना दिया, बहुत अच्छा बनाया है, right? मेरे को कोई रोक ही नहीं सकता इसमें होने से. But after 4 or 5 days, you receive a mail from the company that sorry, you are not selected for the next round, and then you guys worry, oh my god, how did this happen, right? What did I did wrong, right? So, guys, I understand that you have built the financial model very correctly, right? But you must have missed the small pieces which we guys generally look while we evaluate the case studies of the candidates, right? So, guys, these units is something that I have seen that most of the students or most of the candidates do a lot of inaccuracies here, right? So guys, what do I say? That units are very important, guys. Then you have an incubator's assumptions, then we have a COGS assumptions. So what are COGS, guys? COGS are costs of goods sold, right? Or you can say direct costs. So guys, I assume that sterilizers the so COGS are divided into three categories. One is direct materials, one is labor cost, and then another one is other costs, right? So same for incubators also. Then I have, guys, OPEX assumptions. So now what are OPEX assumptions, guys? So once you start from revenue, then you deduct COGS from it, then you arrive at a gross profit, right? Now from gross profit, then when you deduct operating expenses, then you arrive at EBITDA level, right? So guys, OPEX stands for operating expenses, which are basically your non-direct expenses, right? What are direct expenses, guys? Direct expenses are those expenses which depends on the number of outputs that you are going to produce, and direct and non indirect expenses are those expenses which are independent of the number of outputs that you are going to produce. So guys, under OPEX, we have certain assumptions like manufacturing staff salaries, which I've assumed 175 INR thousands per year, then administrative salaries expense, and maintenance expense, then R&D, utilities, logistics, other expenses. Now there is one catchy line here, guys. Just read at my inflation line, guys. Now, inflation in OPEX except for manufacturing staff salaries. Now, here I have assumed that my OPEX will get inflated by 2.5% every year. Right? So, for an example, if in year one my OPEX is 100 rupees, then in other year it will be 102.5 rupees. Right? Assuming 2.5% of growth in OPEX. Right? So, guys, here you can see that I have written out a condition that please don't inflate all of my expenses. You need to inflate all of your operating expenses except for staff salaries, manufacturing staff salaries. That is going to stay constant, right? Now, some people will ask me, or some people will simply think that this is a bogus assumptions, right? Because over the year as inflation keeps on changing, so staff salaries also needs to get revised. Yes, I understand, guys, that this is not a practical assumption, but once you appear for a case study round, right, then there will be some lines that will be put in between like these. So I wanted to raise your eyebrows, and I wanted to get an attention from you guys so that you don't inflate manufacturing staff salaries also, right? Now what will happen here? So you are appearing for a test, right? You are appearing for a case study round, and then you are in lots of pressure, right? I understand there are lots of pressure, right? So you are in lots of pressure. Now what will happen? Now the thing that will happen is that by mistake you will also inflate the manufacturing staff salaries, right? Now you submitted your test, you got your IRR, everything, and you are pretty much confident, अरे यार मैं तो पेपर 4 के आया हूँ, right? And you tell to your friends, मेरा तो यहाँ हो जाएगा, अब तो अपना देख ले, मैं अब कहीं और अप्लाई नहीं कर रहा, right? But you suddenly receive a rejection mail. Now again you are worried. Now what should I do? Right? And you must be wondering what wrong did you do, right? So guys, you can make a mistake here where I am saying that you there can be a chance that my candidates inflate the OPEX for, oh sorry, inflate manufacturing staff salaries also, right? So guys, in short, I am requesting you all, whenever you are appearing for a case study round, right? Or whenever you are building a model, it's not only about interview, guys. Even in your practical life, also, if there are some set of instructions that are supposed to be followed, then please follow it diligently, and please always cross check your inputs which you have placed in your model, right? Then, guys, let's move forward. Then we have capex assumptions. So earlier the capex assumptions were related to the number of months for which like a particular capex will roll out. But here we have the like amount, how much amount we require as a capex expenditure. So first of all, guys, I am going to purchase the land in this particular case study. Land area that I require is square meter of 5,000 square meters, and the land cost is 0.20 INR thousands per square meter of land. Then we have a storage area cost, right? Then there is a depreciation attached to storage area. Then land development cost is there. Then other costs are there, then furnitures, utility equipment and connections and others, right? And for everything I have assumed a different depreciation rate, guys. Now why did I assume a different depreciation rate for everything, right? Because again, I want to get your attention, guys, right? So that it should not be the case that that you were supposed to, like, let's suppose for production facilities I'm putting a depreciation of 20%, right? And for, let's suppose, other capex costs I'm putting a depreciation for 10%. Then it should not be the case that while calculating depreciation you are linking the other capex depreciation number to the production wala depreciation number, right? Because both the rates are different. So guys, again I am raising your eyebrows hairs, right? Please, please, please pay attention to the case study, guys. It's very important, right? Then, guys, let's move forward. Then we have debt assumption. So here the loan payment start date is from. Um, so basically, guys, the loan payment start date will be from, it's wrongly mentioned, or it's mistakenly it is mentioned as 1/1/2025, but here we will assume that there will be a moratorium period for 1 year, right? And my loan repayment will start from 1st January 2029, which means that if I am starting my operations from 1st January 2028 and I say that I have a moratorium period of 1 year, then this means that I am supposed to pay back my loan from 1st January 2029 onwards. Right? Now, what is the moratorium period, guys? The moratorium period means that during that period you are not supposed to pay back your um principal amount. You are only supposed to pay back your interest amount, and principal uh, prepayment is not supposed to be repaid in that particular period, right? Now, um, just think of an example of education loan, guys, where you are given like, till your course time you are not supposed to pay back the principal, right? And after the completion of the course they will again give you 1 year, and after 1 year, like, let's suppose your course is of 2 years, right? Plus they will give you 1 year more. Now after 3 years you are supposed to start paying back your principal amount, right? So this is the meaning of moratorium period, guys. It's not mentioned here, but I will correct this out. I will correct this PDF while uploading, and then probably you can have an updated PDF. Then, guys, loan term I have assumed it for 6 years, then interest rate of 5%, then debt payment option linear and annuity. So basically, guys, in this particular model, we will have a flexibility to switch between linear payment and an annuity mode of payment, right? So we will build both the payment methods, and then probably user will have the flexibility to select among these two on the basis of drop downs, and then probably the outputs will get updated, right? Now there are other methods of also repayments of loan, guys. The other methods can be balloon repayments, right? Other methods can be sculpted repayments, where we are sizing the loans and all, right? So guys, these all things we have kept side for now. If you want to learn, then please contact us. We will be happy to teach you those things, as those are very much advanced modeling topics. And also, if you know those concepts, guys, then believe me, there is no interview or there are no case studies around you are not going to crack, right? Then, guys, let's move forward with working capital assumptions. Then we have account receivables, payables, right? So, an inventory, obviously. So, 90, 60, 30 days is what we have assumed. Then we have tax assumptions. So, income tax rate we have assumed to be 15%, and then we have tax depreciation rate of 15%, right? Now, what does this mean, guys? So, you guys might be worried here that depreciation to I have already mentioned under capex. Now, what is this tax depreciation rate, guys? Right? So, guys, let me just take a step back and let me make you guys understand what is a tax depreciation and what is a book depreciation, right? So, basically, guys, depreciation acts as a shield for your tax, right? Depreciation is a non-operating expense, guys. So, basically, it acts as a shield for your income tax, right? Now, book depreciation is the depreciation that we charge on capex as per the depreciation percentage which we have assumed earlier in this case study. That is the book depreciation, which will be present in your balance sheet and all, right? Now, tax depreciation is something that we are going to use in order to calculate our taxable income, right? So basically, guys, in this particular model, I am teaching you tax in very detail, right? So I will be covering here tax loss, tax carry forward, deferred tax, everything I will cover in this particular case study, right? So guys, just forget what others are teaching. Follow me. I will tell you the most advanced concepts, and I will let you guys know, and I will prepare you guys as the best candidates in the market, right? So guys, these tax laws, tax carry forward, most of the people will not tell you, right? But I am telling you for free, guys, right? So guys, in this particular case study, I will cover tax in very detail, so it will no longer be जो अब तक आप लोग कर रहे होंगे, maybe like where you are just saying, okay, if my earning before tax is less than zero, then don't take any tax, and if it is greater than zero, which means my earning before tax is positive, then multiply that amount with my tax rate and get my tax amount, right? But in practical life, guys, this is not the case, right? There are some limitations rule attached to it. There are some tax losses that you need to account for. There are some tax depreciation rates that you need to account for, right? So guys, we will cover all these in details as we progress in this particular case study. Then guys, we have a return assumptions, because obviously we are supposed to calculate IRR and all. So we have a terminal year, we have assumed it to be year number 10. Then cost of capital as 18%, and then LTGR, which is a long-term growth rate, as 5%, right? So we will also cover these things in detail, right? We will calculate free cash flows to firm, free cash flows to equity, equity IRR, project IRR, cash waterfall, everything, guys, everything I will teach you in this particular case study. And believe me, if you follow this case study in detail, then you already have a good edge among others, right? So guys, I will cover everything in very much detail, right? And I will try to make you understand. I will try to keep it very simple so that every people can understand, right? And also, again, guys, I am very sorry for this typo mistake in this particular piece here. I will correct this out in this particular PDF, which you guys will get through my channel, right? And then probably, so basically, guys, in the video description where I will be uploading this video, so in the video description, you will have a link to download the case study, right? So you can easily download it, and then probably in the next video, guys, we will start setting up this case study in our Excel file, right? So guys, this video was all regarding case study discussion, and then from the next video we will start plotting it out in our Excel file. Whereas in our Excel file, we will take a blank Excel file, and we will start from very basic, guys, very basic, right? Very basic, just a random blank Excel file we will pick up, and we will start plotting, formatting, and setting up the timeline, everything from scratch in that financial model, right? So guys, don't worry, I'm here to help you guys. Just a one request from me: please subscribe to my channel, and please pass it on to the people who want to learn, right? And also, please post it in your WhatsApp groups. I will be giving you guys a lot of content for free, but in return, I want support from you guys, so that like most of the students can get benefit out of it, right? So please subscribe to my channel, right? Please press the bell icon so that you can get the notification as soon as the video gets uploaded on every Wednesday and for Sunday, right? And please pass on it to your friends so that they can also get advantage of this particular free learning. Right now, guys, if you want to discuss about any career options, right, if you want to discuss about your career in detail, right, if you want to learn more, if you want to learn renewable modeling, if you want to learn real estate modeling, if you want to learn valuation modeling, or if you want to take a full-fledged investment banking course, which we guys provide, where we assure 100% placement assistance, where we take 20 plus mock interviews, where we like give you placement assistance also, right? And where we ready you for the future, and where we help you to get an edge among others. Please reach out to us on our WhatsApp number, or you can call on the same number, or you can reach out to us via mail, right? Or you can simply put in a query form fill in a query form on our website, and we will reach out to you as soon as possible, right? So guys, this was all regarding this particular video. Now please subscribe, like, and follow and share our YouTube page to people on LinkedIn, your WhatsApp groups, and your friend circle, right? So guys, in the next video we will start setting up this case study in our Excel file. Till then, bye bye, take care, and happy learning, guys.